I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome back to the show, Mike.
Oh, thanks for having me. It's great to talk with you.
We were just saying off air, an interesting summer on the markets, but it's going to be the end of summer that so many people are concerned about.
Well, it's funny. And in one sense, I think people both bullish and bearish on the market have the same feeling at the very moment we're doing this interview. When I'm speaking of S&P 500 and the U.S. stock market here, we had that drop during that Brexit thing for 2 days that came on very huge volume. And then the market suddenly reversed, and it made a new high. The S&P 500 went through 2100, but in the past 2 weeks it's done nothing. The high was around 2175, and support's about where it is now at 2150, 2140, somewhere in there, and we're at 2150 essentially. So that's a very small, narrow range, and I've seen articles saying this is the smallest range the market's ever traded in like this for 2 weeks or 3 weeks or whatever it is. And so everyone is seeing this, and they're saying, we're going to break that range, and a big move is going to happen. Now, the people bullish are saying it's going to break out, and S&P will go up to 2,200, maybe by the end of the year go up to 2,400 or 2,500, maybe next year go to 3,000. So they're seeing this as the final great time for anyone who wants to buy in order to get rich. Now, I see it differently. I think this is actually a top forming. It's going to disappoint the people buying, and they're going to end up, who are only investing in the S&P 500 and the general U.S. stock market, probably end up losing money from here, between here and the end of the year. Now, here's the thing about it is, so both just about everyone watching the markets closely is anticipating a move happening. Not much is happening today, and the volatility in the market's really shrinking. The 20-day Bollinger Bands are coming very tight together. Last year in August, the same thing happened, and then the market fell for 4 days in a row in a pretty much a disaster drop. And something similar also happened in January. But I think the move won't really start for at least another couple of days. It could even be 2 or 3 weeks, but at least a couple of days here. And there'll be warning signs if it's going to fall. The internals of the market will weaken and get worse. That's actually already starting to happen, and it should continue. What I mean by that is most stocks in the market averages will decline ahead of the market averages falling. If you use StockCharts.com, you can measure this by, they have an indicator where you can see the number of stocks above the 200-day moving average. It started to go down yesterday, so the number of stocks above the 50-day moving average. To give you an example or explanation of how this works, in the NASDAQ 100, only a dozen stocks were in the green yesterday, and the market barely was even down. Normally it would be like 50-50 when the market's barely down. And there's high volume in some of them. So I think yesterday's action was a sign that this is actually a topping formation. If I'm correct on that, we should see more days like that, eventually a break of the S&P 2040 level, and probably, I'm not sure, I don't really think it's going to fall like it did last August and go straight down for 4 days, but instead, I think we could see the S&P go slowly down to 2100 maybe break that, then hold there for a few weeks, maybe bounce a little, and then just continue lower from there for the rest of the year. It's very hard to predict exactly how a price is going to play out. What's more important is to be able to recognize when a trend is changing, and a market that has traded like the S&P 500 has done by basically going sideways for a year and a half with some big drops on high intensive selling, which we saw during Brexit, we saw in January, we saw last fall. It's a sign of internal deterioration that's taken place. It's, I think, a giant topping pattern. But we had this breakout to new highs. And if this was a real bull market, the market would be going up, volume would be increasing, lots of stocks would be participating. So that needs to really the bulls need to be right. If they're going to be right, this needs to continue higher here this month. Otherwise, it's just going to top out and fall. And if you go back through history, there's lots of examples where a market would break out to a final new high and do nothing for a couple weeks, and that would be it, and just go down from there for months on end. So that's a real danger of what we're facing. To give you, a lot of listeners are familiar with the gold stocks, investing in gold stocks and gold, and I am too. I think they're going to go up. They've been going up this year. So it's not like everything's going to crash or decline or go into bear market. There are things moving opposite the stock market. We're in a different type of market than we saw in 2008 or even 2000. We're in a market where we have historically low interest rates, the lowest interest rates ever seen in human history, of negative yields. That's causing some people to say, I don't want to be a part of that. I don't want to lend money to someone and make nothing for it. Instead, I'm going to buy gold. What would you rather do? Lend your money and make 0.5%, or lose money? If you buy Japanese bonds, you actually have to pay them interest. Who wants to do that? A lot of people don't. So a lot of people are buying gold as a safety because you're not going to lose money having to pay people out, and gold's going up faster than the rate of inflation. If you buy a CD, you can make 0.5%. If you buy gold, this year gold's up like 15%. Gold stocks are up like almost 300% from where they were on the January low. So there's money to be made in the right spots, but I like to talk about the spots, but the problem is so many people I know, I'm based in the United States, their only world is watching CNBC and the S&P 500, and they're just oblivious to all these things and just are so, holding on, hoping this is going to break out for them, because those are the predictions they're hearing on TV, and you can't make money just betting on a prediction. You got to really watch the market trend and be aware when something's changing.
Why would anybody put 1 cent into a bond that paid negative interest rates? I don't understand that at all.
Well, the same reason. Look, in 1999, I was buying internet stocks of companies that were going to go bankrupt, and I knew they weren't real. But I was buying those stocks because they were going up, and I thought I can make money that way as long as I got out before it all ended. So that's kind of what's going on in the bond market. The bond market has been in this incredible bull market, and I think this year we're seeing what's essentially a blow-off. What happens with bonds and interest rates is when interest rates go down, the bond prices go up. So the people are betting that this is going to continue, that the rates for Japanese debt, for instance, will just get more and more negative, and they'll be able to sell the bond to someone else, even if for a profit, even if it makes no financial or rational sense. They think the market's basically irrational, is going to get more irrational. I think you're right, though. I don't want to do that. I think it's absolutely silly when there are things that are real that are, starting new bull markets, the gold stocks in particular, that's sustainable, where there are valuations that are cheap, there's fundamentals you can invest in, and so forth. But with bonds, a lot of the managed money for endowments, institutional investors and funds and so forth, they have to allocate a certain percentage of their money to bonds often. That's just the rules that they're under. So that's one reason people are buying these things. Another reason is they see bonds as a safety asset, and they don't have gold yet or silver. And I think at some point they're going to switch their bonds for gold and silver, just like other people have done. And that'll be the ultimate driver that drives bond and silver up for the next 5 years or 7 years or whatever the case is going to be. So I actually think it's an interesting prospect that these bonds do exist out there to the extent they do, because when the bond bear market comes, and I can't predict when that's going to happen. I mean, there's actually been interesting bond action this week where the yields on the Japanese bonds have started to shoot up, and that's taken people by surprise. It's caused the Japanese stock market actually to tumble today and yesterday. That could be the top. I don't know. It's tough, for me to call a top in that. I'm not really the bond expert or something, but I'll just try to use common sense. But regardless, I'm not trying to play bonds either, but the key thing is there will be a top, whether it's happening this week or next month or next year. When it does come, there will be a bear market in bonds, and that will really drive gold to prices that we really can't even conceive of right now. Jim Rickards talks about gold going to 10,000. That's a big return from here. That would make the mining stocks go through the moon, but it's a theoretical number. He has no way to know for sure whether it's going to go to 10,000. Who's to say it goes to 9,000? Who's to say it doesn't go to 30,000 or 50,000? There's just no way to know. We don't need to know that exactly. And I don't think he's really saying we do, but what we do need to know is it's going to go up. And he's definitely right about that.
We'll have more with Mike Swanson right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Mike Swanson, editor of wallstreetwindow.com. Mike, what are you going to do, or what do you predict for crude oil right now? Somebody has told me we're down, it will be going down to, again, almost record lows by December.
Well, I wouldn't be shocked. I don't know if it's going to break the low of February, which was 27.5. The record lows, that's like $10 or something. I don't know if that's what they mean, but I do think it's going to go lower from here. I definitely believe that. I never believed that the bear market in oil ended in January. I do think it will end probably next year, but there's a commodity cycle in which when new bull markets start in commodities, they start first in gold and silver, and then they spread over into soft commodities. In some of those that started new bull markets, the price of cotton, for instance, has exploded. You can look at that as an ETF, BAL. Coffee has gone up and so forth. But oil tends to go up last in the commodity bull market cycle. If you can think back to 2000, gold and silver made key bottoms in 2000, but oil didn't start a new bull market to really 2003. It took 3 years later. So I don't know if it's going to take 3 years from this January, but I don't think it's this year. It could be next year. Regardless, that means we're going to probably test the lows of January, and that could easily happen by December, as you're guest has suggested, it could break them. It wouldn't shock me at all. And I think that for me, if that all happens, it'll be a place I'll probably be looking to invest at some point. Maybe not in December, but maybe next year. I'd like to invest in oil stocks at cheap valuations and get the dividends, but I'm not going to do it until I think the cycles line up, which is this commodity cycle for me. I'm talking about the timing of how these things tend to move. And, it's just going to take some time. And also, in the futures market, the commercial future traders still have a fairly sizable short position on oil that really needs to be reduced to near even. With gold that happened in January and with many commodities that happened in the first quarter, but not with oil yet. And it's just going to take time for that process to take place. And when I look at that, it makes me think it could be time to put in the major bottom or a major turning point sometime next year. So that's what I'm looking at, which lines up with a December drop like you're speaking of.
Some people have suggested that coal is not dead yet, that people are still using it, and it takes a long time to phase it out.
Yeah, well, I think that's true. We've probably seen, if maybe I don't think oil's bottom, but we could have easily seen a bottom with coal and the coal stocks in particular. And the unique thing about the coal stocks is they're basically priced like they're all going to go bankrupt when they crashed, along with oil stocks this year. So they reached lower valuation levels than the oil stocks did. So there's more of a possibility that that turns first before the oil stocks do. So I think, coal's not really going away. It's just it came under threat of being regulated by Obama. It was actually regulated by Obama, but look, whoever wins is actually going to be more friendly to coal companies than President Obama. Trump if he wins, he's a Republican. He'll probably, be lighter in regulations or whatever. But so is Clinton. Clinton is sort of a Republican too. So I think she'll be friendly to the coal companies. She's never said anything I've heard this year to suggest that she wants to hurt them or continue the sort of things Obama's done. She's to the right of Obama on foreign policy and other issues, so she'll probably help the coal companies. She's definitely pledged to help Wall Street, and if that's what they want, that's what she'll do.
Is that one of the reasons? It's really funny, a billionaire saying, I'm going to break up the banks, and Hillary may not be a billionaire, but she's certainly very wealthy, and she does major speeches for the banks, won't tell us how much she's getting paid to make those speeches. But, mixed signals from both of them.
Well, with her, there's a website called opensecrets.org, and you can look up candidates on there and see who's giving them money, who their campaign donors. They can be congressmen, will show you that. But it shows you that for the presidents. And she's raised close to $300 million, and Trump's raised close to $90 million. But the bulk of her contributions, at least the top contributors, who are giving like $5 million and $10 million and so forth individually, they're all Wall Street banks and hedge funds. And I think the reason for that is a couple. One, her family is close to that industry. Her daughter's husband ran a hedge fund. Her daughter worked as a consultant to a couple hedge funds. By doing that, she lives in a $10 million condo in New York City, well paid for the things she does for them. But one of the biggest things that scares hedge funds, I think, when it comes to Trump, but I'm not trying to argue he's the best candidate, just trying to say what's going on, is that Trump has made statements that he wants to get rid of the carried interest tax break that hedge funds have, and Clinton won't do that. So I think just financially, that's one reason why. What the carried interest thing does is it enables venture capital funds and holding companies, such as the one Mitt Romney ran, to buy up companies and report their earnings as long-term capital gains. They defer income as capital gains. It's not like buying a stock like me or you might do in a brokerage account, waiting a year and getting the long-term gain. They're buying companies and claiming the income as long-term gain, and saying that's a carried interest instead of income. And it's this giant tax loophole. And, you're talking about if Trump were to do that, or Bernie Sanders was saying he wanted to do that too. But if that were to happen, you would basically have hedge fund managers who are now paying 15% capital gains on their income being forced to pay 39% or whatever their top income bracket they fall into would end up being. And so that's a good reason for people to donate $5 million or $10 million to Clinton, when if this were to pass, it could cost them multiples of that.
It's interesting. That's a fact that I haven't heard about the U.S. election, and why Hillary appears to be so much in the pockets of those financiers, and why Trump would be against it. Again, Trump will say anything to get elected. We've got down to that, and I joked with somebody else, the only thing Trump hasn't brought up is the size of Hillary's penis.
Well, he did that with Rubio, sort of, in a weird way, but you never know. You never know what'll come out of his mouth next.
Mike, thank you so much for chatting with us.
Thank you. Good to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.